So let's discuss market fundamentals and global macros with Prashant Sharma, Chief Investment Officer with Max New York Life. Prashant, morning. Thank you for joining us. Prashant, let me first start with the mood point. And the mood point is that in the month of September and in the month of October, global investors have been buying Indian equities on every uptick, and domestic institutional investors are making life for foreign institutional investors by selling Indian equities. Why is that?
Hi Nikunj. See, as far as the macro is concerned, I think things are looking up in a reasonably better way compared to what they were about 1.5 to 2 months back. There is the liquidity has been eased further in the Western world, and a lot of that money should ideally flow to markets like India, which are looking quite good from a slightly medium-term perspective. Now, what has happened is correct. The domestic investors have been selling a little bit over the last couple of months when the FI flows have been strong. This could be partly because of the redemptions that most of the domestic institutions that would have seen, given that markets have bounced back quite smartly from the lower levels of say 15,000 on the Sensex. So I think part of the redemptions could be because of that, and partly it could be because of profit booking by some of the domestic institutional investors who bought at lower levels early this year. So yes, it's the flows so far have got balanced out a little bit, with FIs buying quite aggressively and DIs selling in moderate quantities. But going forward, if the confidence in the market remains, I think we are not too far away from a point when flows into the domestic institutional funds also starts picking up at some point. My guess is if the market was to sustain and probably start delivering over the next 3 to 6 months as well, we could see a reasonable amount of flows coming into the domestic funds as well. So I think we are setting up for a decent market performance over the next 12 to 18 months. I think after a very good September, the markets are probably taking a little bit of a breather, consolidating. We've seen a consolidation phase over the last 15-20 days. My guess is once this consolidation phase is over and the reform environment picks up again in the Indian economy, the markets could inch up higher from these levels.
Prashant, what is your sense after seeing technology earnings so far, and does it seem like TCS now is clearly on the top slot?
Yes, I think the earnings have been okay. Pretty much in line with expectations. So I would probably think, given the valuations at which some of these large cap IT companies are trading, the absolute upside from a medium term perspective may be limited. Now my base case is that the revenue growth for most of these companies, now that the base has become bigger, will probably slow down over the next 1.5 to 2 years. And the assumption that we are going ahead with is that INR, the rupee, would appreciate vis-a-vis dollar and other currencies over the medium term. So in that kind of an environment, we don't see too much of earnings growth given a high base over the next 1.5 to 2 years. So in that kind of a scenario, my sense is that while relatively they may be looking okay, but from an absolute upside perspective, the upside could be a little limited from a medium term perspective. I'm taking 1 or 2 years as a medium term perspective, and my sense is that the stocks may not deliver in line with market returns over the next 2 years.
So Prashant, in Q2 and in early part of October, what has worked for you and what has not worked for you so far?
No, I think 15-20 days is too short a period to start analyzing what worked and what did not work. I think over the last 1.5 to 2 months, what is working is the banking sector has been doing well. Some of the beaten down stocks started kind of showing some strength in the month of September. So our sense is the market is probably kind of taking shape, kind of setting up for a reasonable move next year. I think this year, to a large extent, the rally has come with a lot of disbelief. But now that the environment is improving both globally from a liquidity perspective and domestically from an overall macroeconomic environment perspective, considering that we've probably seen the worst and things would start improving a little bit from now onwards, I think the markets are probably setting up for a decent move next year. So we do expect that some of the sectors which are showing the traction, as well as some of the beaten down sectors, could show could probably deliver pretty decent returns over the next 12 to 18 months.
Even though there is a distinct shift in the market opinion towards some of the infra names, do you think it's too early to start, buying them? Is it too early to go overweight on, some capex-oriented names, infra names, builders, asset owners?
Nikunj, I would think so. I think market is now giving you a consolidation phase, giving you an opportunity to start nibbling into some of these names, especially the ones which are beaten down quite significantly and where we see meaningful upside over the medium to long term. The chances are that over the next 1 or 2 months, even liquidity position domestically as well as interest rates would probably start coming off. I think it's a good time to at least start nibbling into some of these stocks to play for a meaningful upside over the next 12 to 18 months. Yes, valuations of some of the larger names may look a little excessive, but if you are probably embarking on a capex cycle, obviously not in the near term, but over the medium to long term, I think the valuations can be justified given that the cycle itself could be pretty elongated once it picks up. So we're okay buying into some of the infra and industrials from a slightly longer term perspective.
Your assessment of two sectors. Number one, consumer staples. At these levels, do you think consumer staples are more like a technical buy, it's not an intellectual buy? And B, pharma. I know you've been bullish on pharma, but currently according to me for pharma, what was a tailwind is now become a headwind, which is the currency.
Starting with consumer staples, I would agree with you that at these valuations you can't probably justify a lot of upside from a medium term perspective. At best, I would say they are a hold, certainly not a buy at these levels, and selectively one should be pruning his position as these stocks continue to go up. On pharma, I would say if you are invested in companies which have a strong domestic base as well as a reasonable export base or presence in international markets, I think you would continue to see some upside from some of these pharma names. So between the two sectors that you talked about, I think pharma is a reasonably better option compared to consumer staples, though both the sectors have done reasonably well this year. But I would say going forward, we would be more bullish on pharma relative to consumer staples.